Guys, the National Treasury is planning to scrap the 364 days Treasury bill. Yes, they're planning to scrap it and replace it with a shorter to medium term bond of 2 to 3 years. And here's why. There's this proposal that is in a document called the 2025 Medium Term Debt Management Strategy that came up with a report showing how Kenya has been performing as a country in terms of debts. Now, according to that paper, to that report, 18.6% of the domestic debt is going to mature in June 2025. When you talk about domestic debt, we are talking about treasury bills and treasury bonds. So the government has to find money, cash, to pay off these debts that are going to mature. And remember, they're not just paying you the interest, they're paying you the initial money that you lent them, the investment value, the debt value that you gave them. And 18% of this comprises of bills, only treasury bills. And most of them are 364 days treasury bills. When you go to the CBK website, or if you've been investing in bills and bonds, you'll notice that most of the time, the 364-day treasury bills, not even most of the time, all the time, they usually have a higher interest rate. Today is 21st January. If you go to their website, you'll notice that the previous treasury bill that was issued, the 91 days, went for 9.56%. The 182 days treasury bill gave 10.02%. And the 364 days treasury bill gave 11.3%. You can see that based on these percentages, you as an investor, you'd want to invest here. Like, you don't mind waiting a whole year to get back your money and you get a higher interest rate. This is money that you're assured you're going to get back in a year, and the interest rate is higher. So this one is more attractive, the 364 days. And as a result, most people would want to invest here because it has a higher yield, and why not? Why not go for it? Even I would go for it. Yeah. In as much as this is a good investment for you as somebody who puts your money here, it's not a good investment for the government long term. The reason why this proposal wants to focus more on medium term debts, that is bonds. Remember, a treasury bill is money that you're going to get back in less than a year. But if they take this away and replace it with a medium term bond of 2 years, 3 years, 4 years, 2 to 3 years, if they issue these types of bonds, it's going to be easier on them. It's going to reduce the pressure on them, because for you to pay back a bond, first you receive interest before you get back your initial money. Let me illustrate this. Let's assume that Ivy wants to invest in a treasury bond and she wants an investment value of 100,000. Since it's a treasury bill and she's gone for this treasury bill that's offering 11.30%, because it sounds attractive, it is attractive. After 1 year, Ivy is going to get back 100K and she's going to lend the government around 88K. This is just an example. You can see that Ivy is going to get back her money exactly after 1 year. Now let's compare this to a treasury bond, the one that they want to focus more on, like a medium-term treasury bond of 2 years. Let's say it's for 2 years in this example. In this case, this has been scrapped off. So now Ivy only has this option of a bond, and she goes for a 2-year bond. The investment value is still the same. It's 100K. Year one, Ivy is going to get 14,000, assuming that the interest rate is 14%. Year one, Ivy is going to get 14,000. This means that the government is going to incur a cost of 14,000 in year one. Unlike in a treasury bond where the government would return back the 100K that has already matured. In year two, Ivy will get the 14K again, and then she'll now get the 100K. You can see the delay, the 1 year gap. It makes a difference for the government. It does make a difference for the government. Even you think about it, when you go to the bank and you take a loan from the bank, you can have the option of paying back the money in 1 year, or you can have the option of paying back the bank or the SACCO or the microfinance institution in like 3 years. For you who is paying that loan within a year, it's going to give you pressure because you have to return the principal amount and the interest amount. But if you took that loan for 3 years, the payment has been spread out for quite some time. It's the same thing with the government. There's more pressure for them to repay this money within a short period of time than there would be if they were to pay you back this money in 2 years, in 3 years. The other concept is in terms of issuing bills. Ideally, bills are usually issued once every week. So it's 4 times in a month. You can see that the frequency is 4 times. But for a treasury bond, bonds are usually issued once in a month. So if a treasury bond has been listed, if you miss out on that bond, you have to wait for another month. But for a treasury bill, if you miss out this week, you still have the option of investing next week. If you miss out next week, you're also going to have the option of investing the other week. You can see that for a treasury bond, they have to issue them 12 times in a year. But for a treasury bill, it has to be 12 times. That is the 12 months times the 4 times they issue in a month, which is 48 times. You can see that there is this frequency, 48 versus 12. And when they are paying back, you can imagine that they have to pay back 48 times than here where they have to pay you back your money 12 times. Assuming that Ivy invested in a bill this month, January, the first week of January, Ivy invested 100K. The second week, she was like, you know what, let me invest another 100K. Then the third week, she's like, you know what, let me invest 100K, another 100K. Those are 3 times. And then on the last month, Ivy invests another 100K. That is 4 times in a month. And like if Ivy was to invest here once and then it's done, in as much as the amount might be higher, but you can see it's quite higher. So next year at a time like this, it's going to be a burden on the government. Let me just call it a burden on the government to pay back Ivy the 100K the first week of January. In the second week of January, the government has to pay Ivy again the 100K. In the third week of January, the government has to pay back Ivy another 100K. And on the fourth week next year, they have to pay back another 100K. You can see here they have the pressure of paying back the principal amount or the investment amount 4 times than here if it's issued once a month. So that's part of the long-term debt management strategy, and all that. The other thing that is in line with this is that when you check out that paper, the government now wants to focus more on internal debts than external debts. When the government has a deficit of meeting the budget, assuming that this year they were not able to collect enough revenue. Remember, the government collects money in form of taxation from you. You have to pay VAT, you have to pay as you earn, you have to pay levies. That's how the government collects money. And they use that money for infrastructural projects. They use that money for public services, building schools, building a dam. And they usually have a budget in place. So if the money that they have or the budgets that they have in place, they don't have enough money to cater for that budget, they go out to us as Kenyans and borrow money from us in form of treasury bills and treasury bonds. Or they can decide to go outside the country. They can go to international organizations that lend out money, like the IMF and the World Bank. If they go out to these institutions, it's going to be a multilateral type of debt. If they can go to the Chinese government or they go to the US government directly and they're like, you know what, lend us some money, we'll pay back. That's a bilateral debt, the one that is between governments. According to this strategy that they've came up with, they want to rely more on internal debts than external debts because this has its own repercussions. Let me explain. If the government was to go to the IMF and take a loan there, okay, they actually have, or they go to the Chinese government and they take a loan there, they're getting that loan in their currency. So if they go to the US, they're going to get money in USD, in dollars. And for us who are paying them back, we have to pay them back in dollars. But remember, our currency is not in dollars. We have a Kenyan shillings currency. There are several things that they can do to pay them back. If the government wants to pay them back, they can decide to use up the USD that we have. The government usually has like some reserves of USD stacked up somewhere. They're like, okay, we'll use this USD to pay off this, to pay off this. So the government is going to take the reserves that we have that are in USD to pay back these loans? What if those reserves that we have that are in dollars are not enough? The government has to go out to the market and exchange our Kenyan shillings to dollars. So they're basically buying dollars in order to repay the debt. That will affect our currency. The value of our currency will go down because now we have more demand for USD and we now want more USD. And the value of the Kenyan shilling will go down, will depreciate. The value of the USD, the dollar, will go up. This is not a good move to the external investors who want to come to our country and invest in us. Again, it's also going to be costly since we are buying the dollars. Okay, it's a good move, but borrowing money internally is easier because the money is already in local currency. We don't have to exchange anything. We don't incur a cost or any cost in terms of exchanging money. So ideally, this is the best case scenario for the government to borrow money from us than them borrowing money from the IMF and also borrowing money from other countries. So this is part of all that. And if this is the target that they're aiming for, it means that the treasury bills or the bonds that are going to be issued have to be more. But then again, if we have more of treasury bills, 364 days treasury bills that are stocked up, it's also going to put more pressure on them to repay them back. Because when you're repaying back, you have to repay the interest and the initial amount. In short, this is a good move in terms of repaying back the money to us who have lent them money. If the time period of paying back this debt can be prolonged, it can be medium term instead of short term, it's going to be a good strategy for us as a country. This move is going to have an impact, of course, on us as investors or as people who lend money to the government. Apart from this being scrapped away, we are now going to have two options, the 91 days and the 182 days. Of course, the interest rate is not going to be as attractive as the 364 days treasury bill. The other one is in terms of money market funds. Part of the money that we put in money market funds is usually invested in treasury bills because they are very liquid. That's why if your money is in a money market fund, you can easily access it, you can easily withdraw it because the type of investment where your money is also short term, is here. Now, the fact that this option is not going to be there, we're going to be having two options, 91 days and 182 days. So if you're going to invest in a money market fund and part of the money or the institution that you're investing in is going to invest here, you can see that these interest rates are not that attractive. So it's definitely going to affect money market funds. Probably now we are going to have fixed income funds become more popular because money in fixed income funds, part of it is usually in treasury bonds. And now we have treasury bonds that are going to be medium term, 2 years, 3 years. Overall, I think this is a good strategy for us as a country because we are now going to manage our debts better. And it's also a good move, especially if the focus is now going to be more on borrowing internally from us, the people, than borrowing externally from international organizations. It's cheaper and it's also good for us. You lend the government money and you earn interest on top. Why not? Why not? This is my analysis. What do you think? What do you think that this move is going to have on us as a country in terms of investments, in terms of you as somebody who lends money to the government, in terms of just the overall strategy, the debt management strategy? Is it a good move? Is it, not a good move? What are your thoughts? I'd love to know them.